On August 12th, U.S. markets surged sharply today on the back of CPI data. Both the S&P 500 and the Nasdaq closed at new record highs, with the S&P 500 reclaiming the 6,402 level. This shift puts the balance back in favor of the bulls. For long-short hedge funds, this meant either being forced to add to large-cap tech positions or scrambling to cover shorts, particularly in high-momentum names that had been heavily shorted. Regardless of the reason, the flow was clearly bullish. For the market to pull back from here, we'll need either a fresh catalyst or an unexpected black swan event. Until then, the prevailing trend remains upward. For investors looking to add index exposure and capture excess returns, there are two paths: chase the rally at these elevated levels or wait for the next pullback window. For now, there's no reason for long-term index holders to think about trimming positions. Patience is warranted. The only caveat is to treat new adds differently depending on your entry price, as higher entry points carry more risk. Turning to the Russell 2000, the IWM is now on the verge of breaking above 228, leading the market higher today. From July 22nd to August 5th, hedge fund short positions in the Russell hit their highest level in a decade. If IWM pushes above resistance, forced short covering could drive further gains. The medium-term goal from a technical perspective would be to catch up to the S&P and Nasdaq and potentially challenge all-time highs, though the timing is uncertain. Options positioning shows a September 19 monthly expiration ceiling near $239, with historical highs at $243. On the downside, the largest open interest sits near $212. A break above $228 in the coming days could shift that ceiling toward record highs. On support levels, we're watching $219-228 for the current breakout zone, with stronger support in the 210 to 216 and 208 regions. After a long consolidation, the Russell may finally be ready to take center stage, presenting a potential swing trade opportunity. Seasonally, August through mid-September is typically a weaker period, so the next pullback catalyst is still unknown. Policy changes and executive orders could inject volatility, so it's worth monitoring the market daily for shifts. Now, let's look at today's data and headlines. Much of the rally in growth stocks was driven by short covering in hedge funds. On the macro side, former President Trump announced he is considering legal action against Fed Chair Jerome Powell. This headline drove U.S. Treasury prices to intraday lows and raised fresh concerns over Fed independence. As for the CPI, headline month-over-month inflation rose 0.2%, in line with expectations, and year-over-year rose 1.7%, also in line. Core CPI increased 0.3% month-over-month, slightly above the prior 0.2% and 3% year-over-year, beating expectations of 2.9%. Core goods excluding autos rose 0.2%, marking the largest monthly increase in a year. These July figures do not yet reflect the latest tariff hikes, which took effect in August. The market is now pricing in a 90% probability of a rate cut in September. On tariffs, here's a quick refresher on who actually pays. In practice, U.S. importers pay tariffs at customs. The cost burden may then be split among three parties: the foreign exporter, by cutting prices to offset tariffs, the U.S. importer, absorbing costs to maintain competitiveness, and the end consumer, facing higher retail prices. The division depends on industry margins and bargaining power, but ultimately, much of it is passed on to consumers. We've been tracking U.S. government revenue and spending since tariffs began. July fiscal data shows tariff revenue has climbed to about $201 billion annually, but federal spending hit $630 billion in July, up 9.7% from a year ago, outpacing revenue growth of just 5.5%. The July deficit was $291 billion, one of the largest ever for that month, pushing the year-to-date deficit to $1.629 trillion, 7.4% higher than last year. At this pace, 2025 could post the third largest annual deficit in U.S. history, behind only 2020 and 2011. Interest costs are surging as well. July interest payments totaled $91.9 billion, and the fiscal year-to-date total has reached a record $1.019 trillion, and this figure could surpass $1.2 trillion for the full year, making interest the second largest federal expense after Social Security and far exceeding defense or Medicare spending. This is one reason markets expect the Fed to cut rates to reduce this ballooning interest burden. On the corporate front, Perplexity has reportedly offered $3.451 billion to acquire Google Chrome. Market rumors had previously suggested Apple might target Perplexity to strengthen its AI push, but a Google Chrome sale seems highly unlikely unless forced by regulators, given Chrome's brand value. Alphabet shares rose 1.25% today and remain near record highs. I continue to hold with no plans to trim. Now to Adobe. The stock has dropped to $338, well below its 2025-2026 forward valuation range of $464 to $581. The core issue is that Adobe's AI rollout has been slow, leaving it heavily reliant on its Creative Cloud and Acrobat product lines, which together generate over 50% of revenue and face rising competition. Without a strong moat in AI, and with many competitors offering cheaper alternatives, the stock's near-term upside is limited. If you don't already own Adobe, I wouldn't rush in. The safer approach is to wait for a clear bottoming pattern and stronger buying volume. The $320-353 range is key support, but a drop below $235 would signal serious operational problems. For those who do buy, be prepared for a long holding period, at least a year, for a potential mean reversion. Nvidia remains in the spotlight after the U.S. government announced new restrictions on certain chip sales to China, and China issued guidance discouraging use of Nvidia's H20 chips. This is not a ban, but it's still a headwind. The key will be Nvidia's August 27 earnings and forward guidance. Technically, the stock remains in a sideways consolidation, with the CPI-driven rally supporting sentiment. Tesla rose today, with resistance near $348. I typically give a little buffer above key levels to avoid false breakouts, so I'd watch $348 rather than $347 as the breakout point. Meta hit another all-time high on strong volume, indicating institutional buying remains intact. The stock still looks like it has room to run in the short term. That wraps up today's market update. If you found this analysis helpful, please like, comment, and share. I'll see you in tomorrow's post-market update at the same time.